The ideal reward to risk ratio is 2-to-1, where we're getting double what we risk. So if we're risking 10 pips on the trade, we'll get 20 pips if the trade wins. Now, this concept all by itself will guarantee that we're going to make money even if we only win half of our trades. Now, the way the market moves a lot of the time, the market just won't go that far. It won't give us the 2-to-1 ratio. So what can we do? Well, my name is Russ Horn, and I am going to show you how to get a 2-to-1 reward to risk ratio without moving your stop loss and without moving your take profit. There's a little trick to entering the trade that can get you the 2-to-1 reward to risk with using only a 1-to-1 target. So I'm going to set up a trade here. Now we're going to take a look at a couple of swings. This could be our entry candle here because it breaks below a trend line. So let's zoom in a little bit. All right, so if we are looking at this candle as our entry candle, our stop loss would generally go above the most recent swing high, which would be right here. So I've got my stop loss up here. I've got my entry at the close of this candle, and 1-to-1 would give me something about here. Now I'm going to get rid of the trend line, but I will mark off the entry candle. So what we've got is an entry, stop loss, and a 1-to-1 target. Now, this is where it gets really interesting. What are we going to do to somehow fudge this in such a way that we can get 2-to-1 out of this? What I'm going to do is use my Fibonacci retrace tool. I know where my entry is going to be. I know where my stop loss is going to be. So I'm going to get my Fibonacci retracement tool out, and I'm going to connect those two lines, my stop loss and my entry. So I'm going to connect those two lines, and what we'll see is the Fibonacci retracement zones, 38.2%, 50%, 61.8%. These are critical. Now, it's the bottom zone that I'm looking for. In this case, it's the 38.2% line here. What I'm looking for is to not enter on the close of this candle, but instead to wait for a retrace up to that 38.2% level. And I will enter at that point. That becomes my entry. My stop loss remains the same. My take profit remains the same. So if I move this up to where that entry becomes and get rid of the Fibonacci tool, we can see now that the stop loss is 33 pips, and the take profit, if it was double, would be 66. And in this case, it's 75. It's just a little bit more than 2-to-1 by waiting for the pullback and getting into the trade at that 38.2% level. And another nice thing about this is you don't even have to be present. You can set a limit order. This would be a sell limit order at that level. And then once the market triggers that order, stop loss is placed, profit target is placed. So you're looking for a 1-to-1 movement, but because of the pullback, because you're waiting for a little bit of a retrace, you're getting a much better price. They call that a wholesale price. You're getting the wholesale price, and the market pulls back, tags your entry, and then continues to move to hit your 1-to-1 target, but it delivers a 2-to-1 reward to risk. Your stop loss is much smaller, and your profit target becomes much bigger. We'll take a look at this with a buy trade. Now, what we've got here are a couple moving averages. This is the 3 and the 5, and I'm looking for a crossover up. Very simple. So on this candle, this blue candle, we get this nice clean crossover to the upside. So our stop loss would go just below. So I'll mark off those levels. I've got my entry, I've got my stop loss level, and I've got my 1-to-1. So the stop loss and the take profit are the same amount. Now, being the entry is here, the stop loss is here, I'm going to use my Fibonacci tool, my retracement tool, and mark off both of those levels. So I've got those levels marked off, and what I'm looking for is to place a buy limit order when we get to the 61.8 or the top part of this window here. The top line is where I would be looking to buy. So I would get into the trade when the pullback happens, not on the close of the candle. The pullback occurs, gets us to the 61.8, and then I would be buying right there. So let me move my entry now down to that level. All right, so now I'm going to delete the Fibonacci tool. And we can see from here that our stop loss is 13 pips and our take profit is 29 pips. So 26 would be 2 to 1. So we're a little bit better than 2 to 1. So this is how we are going to mess with our entries to get a 2 to 1 reward to risk. Now, this is a great tool and it works really well. But I do want to advise that you are going to limit some of your trades by doing this. You're not going to get retracements that always occur far enough to get to that Fibonacci level. Now, if you want a 2 to 1 trade, it's worth waiting for. Some markets are going to move without that retracement, but that's the price we have to pay. If you're looking for the 2 to 1 and you're taking 2 to 1 trades, what you're going to do is really establish the fact that losing money becomes actually quite difficult. If you are winning half of your trades, you are still going to be making money. If you're using this technique, you have to lose 60%, 66% of your trades just to break even. So this technique is worth waiting for. If you're looking for that 2 to 1 in a market that seems to only give you 1 to 1, using this technique and taking fewer trades really is the way to go about it.